Hi guys, welcome back to Father and Son Investing. Today's video is going to be an update to the Treasury bill update that I've already done for July. There's a lot going on with Treasury bills right now that you need to know about so that you can make good decisions on which Treasury bills you're going to purchase. But before we get to that, I just want to take a moment to say thank you to all of you who have watched our channel over the last 3 years. When my son started this channel 3 years ago, I never would have thought that we would have gotten close to almost 10,000 subscribers. We're about 28 short. So if at any point during this video you find something in here that you think is worthwhile, would you please go ahead and hit that subscribe button if you're not already subscribed. Now let's go ahead and get to today's topic, updates for Treasury bills. Just what is happening with Treasury bills right now, what's in the news that will affect what your Treasury bill yields are and which Treasury bills you should be buying. Perhaps the biggest news event that happened yesterday is that the minutes for the Fed meeting that occurred back on June 13th and 14th were released yesterday. Now, I'll tell you, if you ever want to know what the current economic status is for the United States at any given moment, this is a great way to get a good summary. It's about 12 pages long, which sounds really long, but when you see all of the information in there, it's really quite packed, and they've done a good job of keeping it brief. Now, I am not going to bore you with the contents of this whole report here, but there is something that really affected markets recently. And digging through here, we'll see what this says. It says, against this backdrop in consideration of significant cumulative tightening in the stance of monetary policy and lags. So they're saying here, we've been tightening things, but there is a lag in the data after we make these decisions. Almost all participants judged it appropriate or acceptable to maintain the target range for the federal funds rate at 5 to 5.25% at that June meeting. Now, here is an important point in here. It says almost all participants. And in fact, they do say further down, some participants indicated that they favored raising the target range of the federal funds rates another 25 basis points at that meeting, and they could have supported such a proposal. However, it was unanimous in the end to maintain the federal funds rate at that 5 to 5.25%. Let's look a little bit farther down on this same page, and we'll see that it says almost all participants noted that in their economic projections that they judged that additional increases in the target federal funds rate during 2023 would be appropriate. We will get back to that later in this video. They also went on to say that they agreed that their policy decisions at every meeting would continue to be based on the incoming information and its implications for the economic outlook. And they also wanted to stress to the public, they emphasized the importance of communicating to the public their data-dependent approach. We'll see that in one of these articles I'm going to talk about. Let's just quickly then hit what some of these Fed members have been saying in the news recently. Here, June 29th, Chairman Powell was at a conference in Madrid, Spain, and this is what the headline says for his comments there. The risks of overdoing and underdoing rate hikes aren't in balance yet. He goes on to say in the beginning there was little risk of overdoing it and a lot of risk of underdoing it. As you get closer and closer to where you think your destination is, those risks begin to become more into balance. But he goes on to say, I wouldn't say they're in balance yet. What should you read into this? Further rate hikes are coming. It goes on to say further in the article, in terms of interest rates, I think we're just going to have to find our way, said Powell. It wouldn't have been thinkable to have 5% interest before the pandemic, and now the question is that tight enough policy? And a strong majority of the almost overwhelming FOMC participants think that we need to do more to get to a level of tight policy. Just yesterday, July 5th, the New York Fed Chair, John Williams, was giving a speech. Here's what the headline says. Fed Williams, incoming data points to need for higher interest rates. Now remember, I said in those Fed meeting minutes that they were going to emphasize to the public a data-driven approach. And what does Mr. Williams have to say here? He says, I think we have more to do. Williams said during a moderated discussion at the annual meeting, and then he goes on to say, I think the incoming data supports that hypothesis. This particular article goes on to talk about the Fed dot plot, which I'll show you in a little bit. It says that 16 out of 18 Fed officials projected one more rate hike, and 12 out of 18 projected two more rate hikes this year. And now, what do we see in today's news? Well, the Dallas Fed Chair, Lori Logan, gave a speech, and here's what it says in the headline. Fed's Logan calls for more restrictive policy to combat inflation. When you see restrictive, think increased rates. Now, I'll tell you that Ms. Logan, the Dallas Fed Chair, was one of those members of the Fed committee who was in favor of raising rates a quarter basis point. This is what she had to say. The continuing outlook for above target inflation and stronger than expected labor market calls for more restrictive monetary policy. When you see restrictive, think increased rates. She says, I'm very concerned about whether inflation will return to target in a sustainable and timely way. She also went on to say in her remarks that she thought it was important for Fed officials to follow through on the signal that we sent in June. That signal is, I'll show you the dot plot now, rates are going up. If you're interested in finding this for yourself, it comes from the news release that occurs after the Fed meeting, and you'll see here it says Summary of Economic Projections. Just what are the projections? Here's the dot plot. These are the members of the Fed, and they go ahead, each dot counts for one of them. They go ahead and give their projections for where they think interest rates need to be. You'll see that at the 5.25% to 5% interest rate right now, there's only two members of that Fed committee who think that that's where it needs to be. Everybody else is above that, and significantly, the majority of them are at least the 5.5% to 5.75% range. Now, Ms. Logan referred in her comments to the strength of the labor market, and here's a report that just came out today. We see it on CNN Business. U.S. private sector added 500,000 jobs last month. Here's what that means for Friday's jobs report. This goes on to describe a report from ADP. Of course, ADP is one of the nation's largest payroll processors. There's a report called the ADP's National Employment Report that came out today, Thursday, July 6th, and states that there was 497,000 jobs added last month, which far exceeds economists' expectations for 228,000 jobs. Now, the market was paying attention to this report today, and the U.S. market went down initially after this report came out about 1%. Now, this is not the Bureau of Labor Statistics jobs report. That data will come out tomorrow, July 7th at 8:30 a.m., but this report from ADP is oftentimes seen as a proxy for what the jobs report might look like. Now, you may be thinking at this point, he keeps talking about interest rates. What does this have to do with my Treasury bill and its yield? Let's get to that. Of course, Treasury bills are a market which is susceptible to supply, demand, and of course, what's happening in the news. Let's just get a look for what's been going on with Treasury bills. I'm going to bring them in one by one. Here's the 4-week Treasury bill, the 8-week Treasury bill, the 13-week, the 17-week, the 26-week, and lastly, the 52-week Treasury bill. Now, let's just focus in on the last few weeks for Treasury bills. We'll notice that beginning about June 20th, all of these Treasury bill yields start going up, meaning the price is going down because, of course, those price and yields move in opposite directions. Each of these yields on a Treasury bill is going up. Now, if I try to think of this in simplistic terms, on the competitive auction market, those who are placing bids are saying we're not willing to accept yields, obviously, lower than this, which in my mind thinks that they think also that interest rates will be going up. Now, I want to point out just a couple of things here as we look at this graph. One, these are all starting to behave a bit more normally. By that I mean that the longer maturity Treasury bills are yielding higher interest rates. We'll see here that earlier in the year, it was kind of all over the place and really hard to know which Treasury bill you should be buying if you want to get a better yield. But now it's starting to behave a little bit more normally. However, I want to point out one more thing to you. As these interest rates are going up, you'll see that quickly, I'll just give you an example. If you had bought an 8-week Treasury bill back here on June 20th, less than 4 weeks into the future, the 4-week Treasury bill yield has already caught what that 8-week Treasury bill was yielding. So what this says to me is, at least in my mind, I want to stick to the lower maturity Treasury bills or the early maturity Treasury bills, because as interest rates are going up, I don't want to get locked into, say, a 26-week Treasury bill and then find that just a few weeks later, the 8-week Treasury bill is almost yielding what the 26-week Treasury bill was, and definitely the 17-week Treasury bill has already caught it and has surpassed it. So in summary for this video, I think that recent news events are predicting that there is going to be at least a quarter basis point rate hike at the next Fed meeting at the end of July. And in fact, there is a website out there from the CME group called the CME Fed Watch tool. It actually has a countdown for when the next Fed meeting is. You can see it's in 19 days. They show on their website what they think in percentage terms is the possibility is for no change versus a rate hike. Right now they're saying 94.9% that there will be a rate hike. So these guys also are in agreement that things are predicting a rate hike for the end of July. If there is a rate hike for the end of July, that means that your Treasury bill yields should also be going up towards the end of July to keep in line with what money market funds can get elsewhere if they're not buying Treasury bills. Now, I hope this information was useful for you. If it was, please give us a thumbs up. And if you haven't subscribed yet, please hit that subscribe button. Put us over that 10,000 mark. We would love to see that this week. Please share this information with a young person in your life. Get them investing. And this is a great way for them to get a nice return with really essentially no risk. And share this information with other Treasury bill buyers that you know. Until next time, enjoy your investing and enjoy your Treasury bill buying.